All right, welcome everybody. Thanks a lot for joining us today. My name is Clay Malcolm here at Advanta IRA, and I'm delighted to be joined by Brian Briscoe today. And he's going to be obviously our guest expert speaker today, talking about multifamily syndications. Brian, thanks a lot for joining me today. I really appreciate it.
Hey, thanks for having me. I appreciate it too.
Yeah, great. And so just for those of you in the audience, the sequence, I'm going to take a few minutes to just talk about self-directed IRAs and how they can invest in these type of multifamily syndications, what that process looks like. And then Brian's going to take over the bulk of the presentation and talk about his expertise in the space and also kind of a little bit about how he views that space. And for those of you who don't know, Brian is co-founder of Four Oaks Capital, as well as a soon-to-be retired lieutenant colonel from the Marine Corps. And so he can tell us a little bit about that as well. If you have questions about anything that's in the presentation, please feel free to type it into the questions box, and we'll take those questions at the end because we may answer them during the presentation. But do feel free to go ahead and type them in just as the thoughts occur to you. Happy to have you do that. And with that, I think that we'll go ahead and just get started here. All right, well, there's my picture, although you can see my video, so it doesn't really matter a whole heck of a lot, other than to just say I've been a self-directed IRA investor myself for about 10 years, and I've been in the space for a little bit more time than that. And a lot of my self-directed IRA investments have been in real estate. So I really have an understanding of what we're looking for when it comes to investments, what the mechanics are, and how that works into the rest of our financial picture. And I'm also always happy to talk to folks about account types and investment strategies and things like that to the extent that I'm allowed to. And just see if there's a way that there's a match for the account type and the things that we provide with the investments that you would like to get into. So please feel free to contact me at any point, my email and phones, because I'm happy to talk to you about how self-directed IRAs might work into your overall strategy. Now, I do need to just mention the fact that at Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment vendor, investment strategy, and we certainly encourage you to talk to your financial and legal team anytime that you are considering an investment for your IRA. The self-directed IRAs are a little bit different paradigm for some people, in as much as the account holder is really the motive force. And so the due diligence on the investments really fall to the account holder and their team. So bring to bear any resources that you need to vet the investments, make sure it's the right one for you before you proceed. And as far as Advanta goes, again, our involvement is really pretty neutral. Again, we don't give any tax, legal, or investment advice. Our job is really to document the activity of the account so that you get to keep the tax advantages, regardless of which type of investment you're going to do. And so we approach that from a very customer service-based perspective. We have long tenured employees. We've been around since 2003. We're about $1.8 billion in assets that we manage. So it makes us kind of a medium-sized company in the space. So we are big enough to have seen everything, but we're still small enough that you get a two-person team and you have their email and their phone number and you know who to talk to about the things that you have going on in your account. So we're definitely a personal touch kind of organization when it comes to your self-directed IRA. And we do also have FDIC insured cash position. So just so that you know, when your cash is here and stationed and is getting ready to be invested, it is at a bank, it is FDIC insured. And so we do try to protect you in that way as well. So we're thinking about the way that you invest, and we like to be a collaborator in the process that you would like to have go on. And remember that when we're talking about self-directed IRAs, what we're really talking about is with investment strategies is combining the tax advantages with the account type with the returns that you can get from alternative assets, right? So when IRAs started in the 1970s, I think banks and brokerage houses just kind of seized on the rules, and they built a business model around their offering, and it was very successful. And a lot of what their offering is they say, hey, well, we'll be the custodian for your IRA, but while your IRA is with us, it can only invest in the things that we sell. So that's their revenue model and their business proposition. Whereas a company like Advanta IRA we kind of took the opposite approach. We don't sell any investments. We are really a service provider, and we don't give any advice, as I mentioned before. Our job is to document the activity and to make sure that these account types that you see on the screen stay in good standing, so you get to keep the tax benefits. And a lot of people think that self-directed IRAs are actually different account types. They're not. So the account types themselves stay the same: traditional IRA, Roth IRA, 401ks. We handle solos, but often people are coming to us with an old 401k where they're from an employer where they're no longer employed, and so it's eligible to be rolled over without tax and penalty. So I certainly encourage everybody to look at the tax advantaged accounts that you have and see what their performance level is. And if you feel like you can get a better return on an alternative investment, all that may mean is that you need to have that cash moved over to a custodian that handles those alternatives, like Advanta. So instead of handling publicly traded securities, we decided to specialize in the bookkeeping and the administration for all kinds of alternatives, including multifamily syndications, which we'll talk about more here in a moment. But that's really the get, is these account types and their tax advantages with the returns that you can get on alternative investments. And the investments themselves can be myriad as well. So real estate is certainly the most popular broad asset class that we handle, but there's other things as well. So there's cryptocurrency, private lending, private placements, precious metals. But really the great thing I think about self-directed IRAs is you get to bring your own expertise along with your real estate team or your financial team. Bring all those expertises together to create a strategy based on the investments that you think are best. So your ideas and the way that you want to deploy that money really comes into play, because it is you that's creating the strategy. Now, when it comes to multifamily syndication, there's a few things that I like to talk about when we talk about this particular investment, and it's become very popular lately because it has a lot of positive attributes. But there are more than one offering out there, of course, and so there are things to think about as the account holder and thinking about what's best for you. So, which market is the property in? You know, do you want to be on the West Coast, the East Coast, and things like that? And I know that Brian's going to share some of his expertise about that in a little bit here as well. You want to certainly know the participants that are in the deal. So who are the principals? What are their track record? What are their operation history? So on and so forth. Basically the strategy for exiting, or the long-term strategy, the disposition strategy for the project, is certainly something that you want to know. You know, IRA money is often considered to be patient money, quote unquote, because especially for those who are underneath 59, under the age of 59 and a half, because you're probably not taking distributions, or likely not. And so that money can be deployed in a way that might be different than your personal funds if you're needing cash flow or things like that in the here and now. So the disposition strategy of the project is certainly important, and combining that with the rest of your financial picture can make an investment the perfect strategy, or one that doesn't quite fit. So thinking about the end game is always something that I encourage our account holders to do. Level of transparency. So organizations, different deal creators are going to be more or less transparent. So finding out how you're going to get information about the project and what's going on and what your participation is going to be can be very important in terms of whether you choose that investment or not. And then timing of returns. Again, we were talking about patient money versus maybe not, but your age and the account type and the rest of your financial picture can all go into the equation that would make the timing of the returns important. So making sure that the returns on this particular investment are in concert with the rest of your financial picture is obviously one of those things that you'll want to consider. So this is by no means a comprehensive list, but these are some of the things that account holders tell me that they're looking at when they're thinking about a multifamily syndication. And this process is really pretty easy to do. A lot of people think that it's going to be very difficult to engage their self-directed IRA or their tax-advantaged account in a multifamily syndication, but it's actually quite easy. So the process is, one, open an account at a custodian that handles alternative assets like Advanta. We can open your account in 1 business day after we get the completed application. You'll move some money into that account, and typically you'll do that via transfer from another IRA, roll over from an old 401k or make contributions or some combination of those things. So you'll get some money into that new Advanta IRA that you have. And then at that point, you're really going out and finding your investment and creating the investment documents. Obviously, IRA investments are in the name of the IRA, and it's IRA money that funds them, but the IRA also gets the returns, and it's tax advantaged according to the account type. So getting that money engaged in this type of an investment is not terribly it's not very lengthy in terms of time, and it's not very difficult either. Yes, there's some paperwork, and you do need to take a moment to set it up properly, but it's actually a pretty easy way to engage your IRA funds. So I hope that's enough to give you a sketch of what that process would be like. Please feel free to ask for more detail as you need it. And I hope that gives you a sense of your ability to invest in what Brian's going to talk about today. And so at this point, I'm going to turn the screen over to Brian, and he's going to take it the rest of the way. If I can find my mouse here. Got it. And I want to just go ahead and reintroduce Brian, again, co-founder of Four Oaks Capital, and soon to be a retired lieutenant colonel from the Marine Corps. Thank you for your service, Brian. And thanks a lot for being here. And Brian, you are muted, I think, my friend.
That's right. I did mute myself so you wouldn't hear me shuffle papers and take notes. So can you hear me and can you see my screen?
Yep, I have both of those loud and clear. Thank you. And again, welcome, and go ahead and take it away.
All right. Well, these are two of my favorite quotes about real estate in general. One of them, I mean, Will Rogers, was, a comedian, a showman, ended up being a very wealthy man, but, don't wait to buy real estate, buy real estate and wait. And this quote is about 100 years old, and I think it's still valid. I mean, what we've seen over, the last 100 years is just real estate prices appreciate and keep on going up and up and up. And, with a couple of minor corrections along the way. And then John Stuart Mill, landlords grow rich in their sleep. But so what I would like to do a little bit is tell you a little bit about myself. 20 years ago, I was a reservist in the Marine Corps, and I decided that the reserves would be something that would help me develop some other skills. I was a graduate student. I was going to school to get a PhD in math. I wanted to be a college professor. So, along the way, I remember going to a department picnic and, not making fun. I mean, if there's any, mathematicians out there, hopefully you relate and you don't feel like I'm picking on you. But I remember at the department picnic looking around, and it was probably the most socially awkward event I'd ever attended. And at one point, I kind of realized, I needed to do something else besides, sit in an office and go over equations and things like that. And so the Marine Corps Reserves was something that had always appealed to me. I had some friends that were in the reserves. And so 20 years ago today, I was 1 week from graduating boot camp. And then literally, less than a month after getting out of boot camp, the terrorist attacks September 11th happened. So brand new Marine reservist decided to go active duty, and essentially 20 years later, now I'm knocking on the door of retirement. Deployed to Iraq, Afghanistan, a couple other places. Did what most Marines do over the past 20 years, but my current assignment, and incidentally, I've got enough leave saved up that I'm essentially done. I've got one more day where I've got to, shave again, get my hair cut, and put on a uniform, but it's literally go in and get my retired ID card, my retirement documents. So that's where I'm at right now. As far as apartment investing, how do the two go together? Every 1 to 3 years over the last 20 years, we have had to pick up and move. The Marine Corps says, hey, we need you to go here, we need you to go there. And what I started doing is just picking up properties along the way. Every time we would move, I would look at the local market and I would determine whether or not it made sense to buy. And every time we bought, it was with the intent of keeping the properties and renting them out. And so over a 15, 18-year period, I had assembled a small portfolio of single family houses. And what I realized is it wasn't quite doing what I was hoping it would do. I was hoping that, at the end of 20 years, I would have, a lot of cash flow coming in and everything else. And I had some cash flow. I had built up a significant amount of equity, but it hadn't quite scaled to where I wanted it to scale. And so about 3 years ago, we'll go back 4 years. About 4 years ago, I decided that I needed to do something to kick things into high gear, and apartment investing ended up being the answer to that. Paid a lot of money for some coaching and mentoring programs and some educational programs. And then over the last 3 years, my partners and I have built a small portfolio of apartments in the Southeast. And we use a syndication model. We'll talk about that in a second, but we allow other people to invest with us. Incidentally, we are closing on a 144 unit property today. And we've brought in around 40 investors, and out of those 40 investors, about a dozen of them are investing using self-directed retirement accounts. So, we do allow that. And incidentally, something that I'll say about me retiring, it also means that I get to take my retirement account from the Marine Corps and turn it into a self-directed account. And as soon as I'm eligible to do that, I'm setting up an account with Clay and with Advanta. But a couple of questions, questions and answers here. Why invest in apartments? One thing that I like about apartments is you get fairly high risk adjusted returns. And we'll talk a little bit about that later and why that is. But there's also a fairly low risk of loss. Properties, they're physical, tangible assets. And, looking over history, not just the last decade or 2 decades, but, centuries, real estate has done very well at preserving value. There's also an extremely high demand for housing. Everybody has to live somewhere. So there's a supply and demand issue. Once again, we got a slide on that one a little later. And since people have to live somewhere, housing is always going to be in demand. And the last thing is it does perform very well in recessions. We've seen the last couple of recessions, and we're talking about, commercial real estate, not single family. I mean, most people on the line probably remember what happened in 2008, 2009, where property prices in a lot of areas, went down quite a bit. But multifamily and commercial real estate generally doesn't follow the single family trend. So throughout the recessions, the last couple of recessions, the multifamily space, the commercial real estate space, performed fairly well compared to other assets. And I think in the last recession, the default rate in multifamily properties peaked at 0.4%. So that's a very low number. So the properties were at least able to pay the bills and make it through without losses for the most part. So talk about what is syndication. So basically, we syndicate, and if you look at the definition in a dictionary, a syndication is basically where a bunch of people come together, pool resources to do something larger than they can do by themselves. So what we do is we find a property that meets our investment criteria. And then we allow people who are in our network to invest with us. And the key is people in our network, the SEC has some regulations that we have to follow. And the way that we syndicate, we can only provide an opportunity to people who are in our network. So this is something that's true of most real estate syndications, depending on how people set it up. If you want to invest with somebody who has a deal like this, you have to have some sort of relationship with them. You have to get on the phone and talk with them. You have to, spend a little bit of time getting to know them first. But we allow people in our network to invest with us. Typically, our minimum investment is about 500. I'm missing zeros for some reason my brain's not calculating it. $50,000 is typically our minimum investment for these properties. For example, the property we're closing on today has an $8 million purchase price, and we We raised about $2.4 million from the people in our network to be able to close on this property. We do all the work, and the investors collect returns. So for most cases, for most people, it's mailbox money. So that in a nutshell, that is what a syndication is. We basically are going to set up a limited liability company, and we, as the deal sponsors, Four Oaks Capital, the company, form the general partnership in the limited liability company, and the investors form a limited partnership, which means that they have no responsibilities in the company, but they do have rights to income. And the way we set that up is we typically do a straight split on all incomes. So we have a percentage that goes to the investors and a percentage that comes to us. Makes it really simple as far as figuring out who gets what when. But in a nutshell, that's what a syndication is. Now, some of the benefits to a multifamily syndication, is typically we set this up where there is a certain amount of cash flow that's coming off the property. And every company that does what we do will do things a little differently. We will pay quarterly distributions. So every 3 months, we get with our accounting team and we look at the numbers and we figure out exactly what the profit is, and we make a distribution on the property. One of the other big benefits, and this is somewhat muted if you're investing with an IRA or a solo 401k, is there's a lot of tax benefits because you are investing into a real property. So for anybody who's interested in investing, outside of the self-directed retirement accounts, there's a lot of tax advantages you get from depreciation that will offset the income from the property at a minimum, and at best can offset a lot of your other active income and basically reduce your tax bill by a significant amount. So those are a couple of the benefits. We'll talk about some more. Of course, there's the appreciation. The first quote was, buy real estate and wait. And I mentioned that, the prices of real estate have traditionally gone up and up and up over the years, right? And so we can expect that the price of every property is still going to go up over the years, right? There's the second part, which is called forced appreciation. And this is a property of ours we own. It's just next to Clemson University. And what forced appreciation, if you're familiar with like the fix and flip programs you see on like HGTV, we essentially do the same type of thing on a larger scale. So we're taking, in this case, it's an 82 unit apartment, and we are renovating. We're making it look nicer. We're taking the old shingles that don't look very well, and we're replacing it. We're giving the property a facelift. We're fixing up the interiors, adding some vinyl planking floors and painting and new cabinets and counters and whatnot. And we're forcing the value of the property to go up. And so when we look at the returns going to the investors, there's the rents that come in and there's the quarterly distributions, but we're also forcing the price to go up. We're using the natural, normal appreciation that happens year over year. And we're also forcing the price to go up, which improves the returns to the investors. Now, something that really helps us is the idea of leverage. Typically, we seek somewhere between 70 and 80% loan based on the purchase price. For example, the property that we're closing on today, $8 million purchase price, the bank is giving us 80% loan to value. And basically what that means is, 6.4 million comes from the bank at 3.7% interest rate. And if you look at what inflation is doing right now and what we expect the inflation rate to be for the next year, the bank is essentially paying us to take their money because we are paying a lower interest rate than the last year's inflation and what's expected to be inflation for the next year. So, and we'll talk a little bit more about the inflation issue later. But what this leverage does is since we're only investing, 20%, 20 to 20% of the purchase price, and a certain amount of the renovation costs, is when the property price goes up 5 or 8 or 10% over time, the number that we get on our returns on what we have invested is essentially multiplied. So in the case of an 80% loan to value, and where we're putting in 20% of the total costs, you multiply the year-over-year returns by 5, and that's what we get as a company. So if there's 5% annual inflation rate that pushes the property up 5%, I'm getting ahead of myself a little bit, we receive an annualized 25% return on our numbers. So that's just how leverage works. But like I said, I was getting ahead of myself a little bit, but I'll just answer the question right now. What about inflation? I think in high inflationary periods, and we haven't really seen this since I was a toddler, late 70s, but in the late 70s, inflation was pretty high. I think it peaked in the US at 18%. But what a lot of investors do is they move money to hard assets during these inflationary periods. They want to have assets that preserve value. And as I mentioned earlier, real estate tends to preserve value very well in inflationary periods. And over the years, the last century at least, real estate values have appreciated faster than inflation in most years. So if the inflation rate's at 2 to 3%, real estate is typically ticking up at 3 to 4% per year. So what we've been able to see is that even though the inflation may go up, real estate prices are going to go up faster than inflation. We've definitely seen that in the last 2 years. And then there's the other part, the rents. Rents are also going to typically track inflation. So, the consumer price index came out last week, and the report was we're at 5.4% over the last year from July to July. So we've also seen a corresponding uptick in rents. And what that does is it increases the income coming in on the property, which actually helps the returns quite a bit. So for the most part with real estate, the returns are inflation adjusted. And if you look at, once again, using this property we're closing on today as just an example, a 3.7% interest rate on, a $6.5 million loan, if rents are going up faster, if the inflation rate's higher than our interest rate, the bank is literally paying us to take their money because, rents are going to go up faster than 3.7. The value of the property is going up faster than 3.7. So even though inflation is bad for the economy, inflation is actually fairly good for real estate investments. Now, I'm not going to be cheering for high inflation rates, but if there are high inflation rates, we are actually going to be in a pretty good position to benefit. All right. So a couple of reasons, just besides that, why we're still bullish on the market. There's a lot of indicators and a lot of things that we see that, lead us to still be optimistic. If anybody's been tracking what's been happening in the multifamily space, commercial real estate space, prices have essentially skyrocketed over the last couple of years. And, a lot of people are asking the question, are the prices too high? When you put things in terms of, what the inflation rate's been over the last year, if you just look at that 5% inflation, that says that real estate prices should go up about 5%. And in the multifamily space, they've gone up a little bit more than that, but I don't think we're too terribly high. But recent report, and I think this was released by AP, so you can see it in a lot of different places. This is just a snapshot from the Wall Street Journal. But basically, what this recent report says, and you can see it in the headline, the U.S. housing market needs 5.5 million units to meet the current demand. So out of all the housing units available, we're still 5.5 million units short in the United States. And going into a little bit more detail, it basically says that we are 2.4 million multifamily housing units short of current demand. And that 2.4 million in multifamily is 5 and above. It's not even counting the duplexes, tris, or quads. So commercial multifamily, 5 units and above, the US needs to create 2.4 million more units before we meet current demand. Now, What the article also said is if we go back to 2005, which is the year that we had the peak amount or the highest amount of new housing developed in a single year, if we were to maintain that rate for the next 10 years, or it would take 10 years for us to meet the current demand. So looking at the supply and demand, part of the reason that real estate over the last decade or even century has increased faster than inflation is because of the supply and demand imbalance. There's more demand than there is supply, which is pushing prices up and up. And according to this study, there's a lot of different studies that have slightly different numbers. Another study came out a couple of months ago that said there was about 4.5 million units short. But every study says that we are extremely short, and every study says that it's going to take at least a decade to solve the problem. So at least for the next 10 years, there's going to be the supply and demand imbalance, and we're going to see that prices are going to go up because of the supply and demand imbalance. There's also a big demographic shift, and this is this graphic is from the author of the book, Big Shifts Ahead, and basically what we're seeing, the biggest generation, if you look at who's in the U.S., the largest generations are the people that were born in the 80s and 90s, and these are the people that were young and impressionable during the housing crash of 2008. And consequently, a lot of these people are putting off home ownership. They look at home ownership as being a risk, and they are renting in lieu of buying. And we saw that in the last several years, the home ownership rate reached an all-time low. It's since rebounded slightly since that all-time low. But what we're seeing is those who were born in the 80s and 90s are looking to rent. They're putting off home ownership until a much later age than say my generation. I'm a child of the 70s, but since they were heavily influenced by that real estate market crash, they tend to rent more than purchase, which is another shift that's really beneficial to us in the multifamily space. Now, something else that we're bullish on is we're tracking where populations are moving. Okay, now this particular graphic, the information was taken from United Van Lines, a company that moves people from one point to the other. So they're looking at where their trucks are moving from and where their trucks are moving to. Green states are the states where people are flocking to, and the pinkish states are where people are leaving from. And so I got another slide next that also shows trends, but you can see that the Southeast has a lot of gainers, and incidentally the Intermountain West does as well. I am currently in Idaho Falls, which is about right there, just moved from DC area to where my retirement location would be. But so Southeast, that was a little premature. Let me go back if I can figure out how to. There we go. So the Southeast is doing extremely well. South Carolina, so I think 6 of the top 10 states are in the Southeast, 6 of the bottom 10 states are in the Northeast. Next slide, we'll talk a little bit more about what's happening. Now, this particular slide was taken from How Money Walks website, and they basically analyze IRS data. They look at people's addresses from year to year in aggregate and determine where money is moving. So what you can see is, once again, the same trends. You've got a lot of red up in the Northeast and a lot of green in the Southeast. You also have, red in California and a lot of green around here. And basically what that means, the green states are the net recipient of money when people move, and the red states are losing money in the form of income every year. And just to give you an idea of how much this is, New York, $129 billion has left New York in the terms of annual income in 2019 alone. All right, so California, 82 billion is what it's lost. All right, so a lot of money are leaving these states, and they're going to places like South Carolina, 31 billion. You gain. North Carolina gained 42 billion. Georgia, a paltry 19 billion. Florida is a big winner, 205 billion. So you can see some of the trends here. I think I have another slide that, nope, I don't. But what's happening nationwide is generally people are moving from high cost of living states to low cost of living states. They're also going from areas with high population density to areas with low population density. And this data right here that's on the map was the last year they had was 2019. So this is pre-COVID. I think COVID has actually accelerated because COVID is something that really targets people who are densely packed. So people in New York City are tending to move from the city into the suburbs or into the areas where there's more freedom of movement, more area to move around. So trends in a lot of areas are focused on the Southeast US, where property prices are cheaper, where for the most part the business environment is more favorable. Every state's a little bit different. The weather's warmer. That's also a big trend, but the big winners right now are the Southeast, Texas, and the Intermountain West are where a lot of the big winners are. And our firm, we focus on the Southeast. Right now, we've got 8 properties in South Carolina. We got 1 in Georgia. 2 of my partners live in North Carolina. My wife and I have spent a considerable amount of time in Carolinas. Both my wife grew up in Columbia, and I've been stationed in North Carolina for quite a while. So our company is focusing on these demographic trends, and we're keeping our fingers on the pulse of what's happening. And right now, the Carolinas and Georgia are very hot markets. And one thing that's more important than just being the markets that are hot, they're markets that we know well. One of my business partners, our acquisitions director, born and raised in Columbia, went to school in Charleston, and he lives in Wilmington, North Carolina right now. His day job for the last 10 or 15 years, he was a medical device salesman, where his territory was North and South Carolina, where he was traveling every single day for his W-2 to other areas. So we know the areas extremely well, and we're able to capitalize on this. And that was one thing that Clay brought up, is that you want to know that the operators that you're dealing with have experience in the area, and the areas are doing extremely well themselves. But just to give you an overview of what our properties look like currently, and this is for the most part chronological, but our first couple acquisitions were 2019. These 2 properties, you see that the 2 from left to right, we purchased as a small portfolio. They're in downtown Spartanburg, South Carolina. And incidentally, the U.S. Census has pegged Spartanburg, I think, as the 20th fastest growing city in the United States. So these assets are poised to do extremely well. There's been a substantial amount of appreciation so far. This one right here, Low Country Townhomes, is actually a Section 8 property, which we've been able to come in and fix it up a lot. A lot of people look at Section 8 as potentially being slums, and quite frankly, it probably was a slum when we purchased it, but we've come in and since poured, almost $1 million in renovating the property, new windows, new siding. And what that's going to do for us is it increases the value of the property. We're able to attract better tenants, even though it is Section 8, there's still, various levels of tenants within Section 8. We're able to attract better tenants, and we're able to have higher occupancy rates and a lot more value added from just the renovations we've done. A couple other properties, this is my favorite to talk about right here, Wynwood Garden Apartments. We bought this property, we got it under contract in late 2019 at $2.4 million. We've had a couple of offers, unsolicited offers from people to buy this property. Highest offer so far has been at $4.8 million. So, we bought a 2.4. We put about $800,000 in renovations into this property. So our all-in price is, somewhere in the mid threes, and we've got offers on the table between 4 and 4.8 million. So I think this is a classic example of how things should work. When we bought it, it didn't look as nice and clean as it does now. This is the one by Clemson, which you saw earlier in a slide, where we're fixing up the exteriors. Once again, this was something that we bought at a really good price. We're going to put in over $1 million into this property to fix it up and to make it look sharp, and to be able to sell it off at a higher price in a couple of years. Our only Georgia property happens to be our largest property, 167 units. We're going to put about $2 million into this property. And we bought this property, this is a great story, but we bought this property at 7.1 million about a year ago. And when we bought it, we had the owner's previous appraisal, and it had appraised in 2019 at 8.4 million. So between 2019 and now, it's definitely appreciated. This property is probably worth high 9 million, maybe low 10 million, and our basis on this property is 7 million. So if you're catching the trend, what we're looking for is properties that we can buy that need a lot of TLC, and we can come in, force the appreciation, and be able to capitalize on fixing properties up, capitalize on properties that were mismanaged or poorly maintained, and be able to pass those profits on to our investors. And last slide, this live Florence is the one we're closing on today. Also, same thing. It's one of those that's been a little bit neglected. This is the best picture we could find. It does look a little rougher than this, but we're going to make it look beautiful and be able to, once again, force the appreciation, force the value to go up, and be able to capitalize on that one. And then we have two small units, and quite honestly, the only reason we purchased these smaller units, you got a 28 and a 40, is because they're just blocks away from our other properties. So this Northway townhome is, I think, 3 blocks away from Wynwood, which is this property right there on the left, and Cascade Point's in the center. It's about a mile away from the other property. So we were able to capitalize on location. Having 2 properties in close proximity does make management much more efficient. So at the end of the day, that's what we do as a company, is we are looking for the value add properties. We're looking for the properties that, may be a little bit ugly that we can fix, may have management issues that we can fix, may have low occupancy that we can fix. We're looking for problems that we can fix. We're taking advantage of the normal appreciation, and we're forcing a fair amount of appreciation in. And something Clay mentioned that you should be looking for is timing as well. So if you're looking at what we do, what our kind of bread and butter model is we're looking at about a 3 to 4 year hold. And IRA money is very patient money. I'm mid 40s. I can't touch my retirement funds for at least another 15 years. So what we try to do is maximize the return. And just the way commercial real estate works, we're buying a 144 unit property closing today. It's fully occupied. So for us to get in and occupy the interiors, we have to wait till some leases come up, and essentially it's going to take us about 2 years to do the entire, value add, to do all the renovations that we have planned. So on this live Florence, we have, I think, $1.3 million, in the bank for the renovations right now. And it's going to take us about 2 years to do it. So we do the value add in 2 years, and to get the maximum amount of price, we have to have a stabilized property. So at the 2 to 2.5 year mark, we stabilize it, which means we just operate it at its peak performance, and then we're able to sell right around the 3 year mark. And what that does is it maximizes the returns to the investors. Once we get past the forced appreciation, the only appreciation that's going to happen is a natural appreciation. And what we're seeing to our numbers is the average annual returns drop significantly after the forced appreciation period is over with. So not promising, I can't promise any returns, but what we're finding is 6 months to a year after we finish our renovations is the best point to sell to maximize the returns to the investors. And so that means about 3 years on the projects we're doing, which means if somebody gives us, for example, this Florence deal, the 144 units, we expect to return the member capital. We expect to return the locked up equity that we're going to create about 3 years from now, and allow our investors to take that money and invest it somewhere else. All right. Finally, here's our team. So Todd Butler is our Director of Asset Management. currently lives in South Carolina. Eric Shirley currently lives in North Carolina as our Director of Acquisitions. I just moved to Idaho Falls. That's me. Brian Mallon's our investor relations guy. He's also in North Carolina. Kranti is a new partner out of San Diego, California. Deb Pritchard is out of Texas, and Kelsey's also out of North Carolina. But that's the Four Oaks team. That's who handles all of the investments that we bring to the table. And I think this is my last slide. Oh, no, one more slide. If you're interested at all in anything, or if you want to learn more about what we do, the website is fouroakscapital.com. And this is a screenshot of what it looks like right when you log on. There is a little button right here to schedule a call. Like I said, in order to invest in real estate syndications, you have to have some sort of relationship with the operators, and this is the first step. So whether you're investing with Four Oaks Capital in a syndication or another company, the first step for you is to set up a call, schedule a call, and you'll be able to ask any questions that you guys want. And now this is the last slide, and that concludes the presentation.
All right. Thank you, Brian. Appreciate that. I'm going to go ahead and put our contact information up on the screen. And for those of you who have questions, please go ahead and type them into the questions box. And I know that Brian and I can hang out here for a minute or two and talk about any questions that you have. So please feel free to type those in. There's one that's already in there, Brian, that says, what is the cap rate on the property? And I think that it was typed in somewhere where you're talking about the one that's adjacent to Clemson. Okay. But I think also, what's your general view when you guys are analyzing a property? How do you look at cap rate? How much weight does it carry? That kind of thing.
When we're purchasing a property, we don't put a lot of weight on cap rates. And I think that the reason why the cap rates work well with efficiently run properties, and we are looking at properties that are not efficiently run. So if you look at the valuation formula, you take your NOI, you divide it by a cap rate, and it spits out a value. Because these properties have low NOIs based on the current market, they're not being run well. The rents aren't at market rate. They're a little bit dilapidated in some cases. We're dealing with properties with extremely low NOIs. We've actually purchased a property with a negative NOI, and since fixed it up. So when we purchase, we don't look at cap rates, that much. What we do when we're looking at cap rates is we look at the cap rates on the exit. So when we're projecting where we're going and what we're going to be able to sell the property at, we are looking at cap rates on exit. But as far as what we're seeing right now on the cap rates in the Southeast, C class, which is your workforce housing, the 30-year-old type product, is typically trading in low fives. And 2 years ago, C class properties were trading low sixes. So we've seen cap rates go down by almost a full percentage in the last 2 years. There's a lot of things that are leading to this. I think the amount of money that's flooded the marketplace has pushed things down, pushed cap rates down and prices up. And for people who are not aware of what cap rates do, if a cap rate goes down, the price goes up. So the high construction costs have pushed existing real estate prices up. So there have been a lot of factors that have pushed those down. But yeah, as far as what we're seeing for C class, where we're operating low fives, for A class and B class, we're in the 4 range.
And the next question, I'm going to actually paraphrase it because it's partially something that I also had some curiosity about. Is when you go out to do your due diligence on a property, there must be some indicators that you look at on apartment buildings. It sounds like, and this person's talking about the question is about essentially what are the indicators that a building is either not being run well or has some these kind of fixable problems that you had mentioned.
A lot of the indicators, we just know the market well. So one big indicator is the rent price. So if you look at the market, for example, the deal we're closing on today has the lowest rents in the entire city. All right, that tells you that something there is not right. Okay, so and as we're putting a deal together, we are going to look at what the comps are, what the comparable properties are doing. So we're buying a 70s vintage property. The unit sizes, the units are fairly large, and this particular property has everything between 1-bedroom to 4-bedroom apartments. And so looking across the board, the rents are lower than every other apartment in the entire city. So that's one indicator there that it's either being managed ineffectively or it's not in really good condition. And before we put an offer in, right now we're only putting offers that are on apartment buildings are within reasonable driving distance of one of the partners, right? So before we put the offer in, we're walking the property, with the brokers, and we're at least getting a bird's eye view of things, and having been in the business for about 3 years, we have a pretty good idea of what prices are going to be to renovate things. So, we do a property walkthrough prior to coming under contract. But we also know what the other properties look like. Some people call it secret shopping, but we will go to the neighboring properties and we will try to get into, a lot of them will have a demo unit that they'll let us look at, so just being able to compare, the quality and condition of the units where they're at when we're putting the offering in to the quality and condition of the adjacent units, tells us where we can push our rents, so if the average rent for a 2-bedroom is $100 less than the average rent in the community for the same property type, same age, and everything else, we're pretty confident that we can get rents up by $100, and then we compare condition and we just say, this is how much it's going to cost us to push rent up by $100. And that's essentially what we're doing. So indicators are basically what the market comps look like. And that goes from top to bottom, what the market comps are charging as far as rent, what the market comp amenities have, what the market comp condition is, the size of the units, and everything else. And that's essentially what we're looking at, is we're trying to compare apples to apples as frequently as possible to be able to figure out, number one, what it's going to cost us to do the renovation and what we're going to get on the backside of the renovations.
Makes sense. So this kind of dovetails into another question that was asked about. It says, what are the elements of an apartment rehab versus a single family rental rehab?
With apartments, you're typically dealing with smaller spaces. I think, the average 1-bedroom apartment, 600 to 700 square feet. The average 2-bedroom apartment's about 800 square feet. So your scope per unit is a lot less. You're talking about, 2 small bedrooms, a small living room and a small kitchen. And so when you're going into these apartments, the price per unit is less. But the other nice thing is, 144 units, if we're coming in and we're putting the exact same LVP or the laminate vinyl planking on the floors of 144 units, we're buying in bulk and we're getting a discount on the price when we purchase. We're actually putting the same ceiling fans in every single unit. Doesn't matter if it's in upstate South Carolina, Florence, South Carolina, or Georgia. So a lot of these things, just by the sheer scale that we're doing things, number one, we're able to nail down the best price available, and we're able to basically use a cut and paste type approach to the renovations. And the other thing is, the numbers. I mean, some of the numbers that we're spending on things would make a single family flipper, freak out. But when you're looking at exteriors, I think we paid like $150,000 to do the exteriors of the building, just changing the roofs out, the mansard roofs, and putting that sheet metal on. But when you go back and look at price per unit, it was less than $2,000 per unit, which is a very manageable process. So I think when you're looking at scale, the price doesn't actually scale with the units, which is nice. So we are spending on average about $10,000 per unit to do the renovations, interior and exterior renovations. You know, and once again, I don't know if I mentioned this, but we focus on C-class properties, which is generally workforce housing. You know, the people who have, you know, the day laborers, the tradesmen, the journeymen that are going to be living in those properties. So the types of renovations we're doing, you know, we're not making things luxurious. We're giving good, clean, safe housing for people who work for a living, essentially.
All right. Next question is, what is the expected cash-on-cash return of the asset you're about to buy?
The cash on cash, and the numbers, I think we're going to hit 7 to 8%. And just a little caveat on that, you know, we're buying properties that are not performing well. So typically the first year's cash on cash is fairly low. You know, so when you're buying when you're buying something that's a little bit distressed or rents are $100 to $200 behind market, first year cash on cash is low. As we start executing our value add plan and increasing rents and sometimes refreshing the tenant base, you'll see those numbers come up. But average over 3 years, we're looking at about 7%. You know, year one, I think our number was about 2%. You know, year two, we were closer to 7, and year three, we're closer to 10.
Weather seems to be more extreme this year than last. Do you look at potential weather issues when deciding to purchase a property, or are you fully covered with insurance, I guess, and/or?
Yes, both. Yes to both. I mean, most of our properties are in upstate South Carolina, so when, you know, hurricanes come through, the force of the hurricane dies down by the time it gets in there. You know, we don't have any coastal properties. We are very well insured. You know, we have, you know, we're closing on our 9th property right now. We have basically a package deal from the insurance company where, you know, all of the properties are on the same policy, essentially. So what that allows us to do is get better insurance for cheaper, if that makes sense. But I think good point. You know, there are a lot more extreme weather, you know, things happening. And what that's done for us is our insurance prices have actually gone up. You know, 2 years ago, I think the average per unit insurance price was about $250, you know, per unit per year. And right now we're looking at numbers at around 400. So insurance prices are going up significantly. You know, there's a lot that goes in there. You know, where you're located. If you're in the tornado belt, insurance is going to be a little higher. If you're in a coastal region that's prone to hurricanes, your insurance is going to be a lot higher. You know, so we try to avoid, you know, the floodplains. That's something that we're looking at. But overall, you know, it's all about mitigating the risk. So if we are in an area that's, you know, a little more prone to extreme weather, our insurance policy is going to cover it.
Okay. You talked a little bit about this in another question, but I'll serve it up again just in case you want to add anything. It's talking about how do you find your properties? Or what kind of search methodology are you using, that kind of thing?
We typically use brokers. Stat that I saw a couple of weeks ago, about 93% of multifamily properties are brokered, you know. So I do know a handful of people that are trying a direct to owner approach. You know, we have tried to build relationships with other owners, but in general, we're going with brokers, and we're just trying to be top of mind with a broker when something comes up. So, you know, that means that our acquisitions team is, you know, trying to be really quick to respond to the brokers when something comes out, and, you know, part of that's just making very credible offers that, so we're not wasting the broker's time, if that makes sense. So in essence, we're on the phone, and when I say we, you know, my partner Eric and Kelsey, our acquisitions team's on the phone with brokers, you know, probably from beginning of the business day to the end of the business day.
Okay. Next question is, can I apply my 1031 exchange property to the program?
Yes. And most, in any syndication you can. I mean, the process of doing it is we'll split up the ownership of a property and a tenants in common. Our attorney can handle 1031 exchanges, but basically what we need is a little bit of lead time because it's not something that can be done immediately, if that makes sense. So as long as it's done early on, and we're talking right around the time that we get a property under contract is when we need to start that process. So if you have 1031 money that you're trying to move now, the answer is no, we can't help you because we don't have a deal in the pipeline right now. We've got several offers out, but if you're talking hypothetically about something in the future, we could potentially help you.
Okay. And this question is about the timing of when you're looking for money. So do you start looking for investors after you have the building under contract is the question?
Yeah, so typically what we do is we wait until our due diligence period is over. We've gotten into the property, we've inspected every single unit, and we do get into every single unit. We'll bring a host of contractors with us to look at things like the roof and the siding, and help us to fine tune our renovation budget. But once we have our numbers fine tuned, right at the end of the due diligence period, that's when we formally announce to our investors that we have an upcoming opportunity. So typically we look at it, from the day we have it under contract, 60 to 90 days is how long it takes us to close. And somewhere around the 30-day mark is when we make the announcement, hey, we have this opportunity coming up. Somewhere around the 45-day mark, we will have a webinar that discusses exactly what we're doing. And somewhere around the 50 to 55-day mark is when we start taking funds. So in general, from first announcement to when funds are coming in is about 30 days. And we do fill up very quickly. This last raise we did, we needed 2.4 million. We opened our portal at 9 a.m. and by close of business, we were oversubscribed. So if it's something you're looking to get into, hop on a call with us and be ready for the next one.
Okay. That looks like it's it for the questions. So, and we're right about time. So I'll just, any parting thoughts, Brian? Anything that you'd like to share with folks about as if they're thinking about a multifamily syndication?
I think the first slide had, my opening thoughts and my closing thoughts. I mean, real estate is not an alternative investment. Real estate is the original investment. The people who had wealth for centuries and millennia were people who owned land. So don't look at real estate as an alternative investment or alternative to the stock market. I think Clay hit the nail on the head. The way things have gone in retirement accounts, at least, has been through brokered accounts that companies who create the accounts are pushing. But real estate has been the original investment, and it's been the original investment because land holds its value. They're not making a whole lot more of it, and it's something that's always going to be in high demand. So don't wait to buy real estate. Buy real estate and wait.
All right, thank you. And thanks again for spending your time with us. For those of you who don't know, Brian is a pretty prolific educator, and so it's great to have gotten him on the schedule, and I appreciate you spending some time with us today, and giving us some background information on multifamily syndications and how that works.
Well, thanks for having me. I appreciate you giving me the time.
You got it. All right, everybody. So our contact information is up there. If you have follow-up questions, please let us know. We're happy to go ahead and answer those as you start to develop a strategy, or if you're thinking about what your next investment is going to be. We at Advanta IRA, we do have a lot of educational webinars like this, so please feel free to keep looking at our events page on our website to learn about investments and just learn how to invest and strategies and different things that you might not have considered, because we always feel like an educated investor is more likely to make the better choice for themselves. So thanks a lot for joining us today, and we will see you on the next one.
All right, thank you, Clay.